Imagine looking at a dashboard, right? And half the warning lights are just flashing bright red, but the GPS is cheerfully telling you that you are on the fastest route to your destination.
Yeah, that is a terrifying drive.
It really is. But, I mean, that is the exact paradox we are facing today with SoundHound AI. We are talking about a stock, ticker symbol SOU, that
Hmm.
recently crashed from its staggering highs. It's
Right.
been locked in this falling trend. Technical sell signals are just flashing left and right. And yet, Wall Street analysts are calling it a strong, moderate buy.
Hmm.
And meanwhile, an army of retail traders is aggressively defending the stock like it's, the last stronghold of the AI revolution.
It is a massive contradiction. And I mean, it really demands a closer look. You have this heavy institutional caution clashing directly with extreme retail optimism. And it's all centered around a company that sits right at the bleeding edge of artificial intelligence.
Exactly. So is this stock a massively undervalued AI pioneer that's just, catching its breath? Or is it a dangerous value trap waiting to crush retail investors who are left holding the bag?
That is the $1 million question, or, well, the $3 billion question in this case.
Right. So that's our mission for this deep dive. We're going to tear apart SoundHound's financials, analyze the technical charts, and examine some highly questionable insider activity to figure out the truth behind the ticker as of today, April 17th, 2026.
Let's get into it.
But first, before we jump into the numbers, a quick piece of housekeeping. If you are joining us on YouTube, hit that like button, subscribe to the channel, and it is absolutely compulsory that you leave your feedback in the comments section below. We really need to know where you stand on this debate.
And just to establish the ground rules for that debate, this is a natural human exploration of the data. We are analysts looking at the market mechanics. Absolutely no financial advice is being given here.
Just zero financial advice.
Right. We are just looking at the facts and the forces driving this wild volatility. And to really understand that wild ride, we have to separate the AI hype from the fundamental reality.
Yeah, because a 61% profit margin sounds great on paper, but I mean, a high margin doesn't keep the lights on if you are bleeding cash everywhere else. So before we even glance at the stock chart, we need to look under the hood.
Definitely.
Does the actual business engine justify all this attention? Let's start with the income statement for the full year 2025. SoundHound reported annual revenue of $168.92 million.
Wow.
Yeah, they are claiming a massive 99% year-over-year growth. They practically doubled their revenue in 12 months. But wait, I have to push back here for a second.
Okay, go ahead.
In the AI sector right now, isn't everyone growing? I mean, is that 99% actually impressive compared to like an NVIDIA or a Palantir?
Yeah.
Or is it just a tiny startup doubling a tiny number?
Well, it is a valid skepticism. When a company goes from, say, 1 million to 2 million in revenue, a 100% growth rate doesn't mean much. But scaling from roughly $85 million to nearly $169 million in a single year, that shows real commercial traction. They aren't just selling a prototype anymore, they are deploying at scale. But what's fascinating here is what happens to that revenue as it moves down the income statement.
Okay, lay it on me.
They reported a non-GAAP gross margin that expanded to 61% in late 2025.
Let's break that down for anyone who doesn't live in the weeds of corporate accounting.
Mm.
What exactly does non-GAAP mean in this context, and why is that 61% number so significant?
Sure. So non-GAAP basically means they are stripping out one-time unusual costs, things like stock-based compensation or restructuring fees.
Okay. To show the actual daily operations.
Exactly. It shows us the underlying health of their day-to-day business. And gross margin is what's left over from revenue after you subtract the direct raw costs of delivering your software.
Right, the unit economics.
Right. In the tech world, if it costs you $1 to process a voice command and you charge $1.10, you have a terrible margin. Your unit economics are fundamentally flawed.
You never survive.
Exactly. At 61%, SoundHound is proving that their core technology is profitable at the unit level. As they add more customers, they are keeping a larger piece of every dollar that comes in the door rather than, spending it all just to keep the servers running.
But they are clearly spending it somewhere, right? Because the profitability problem is still glaring.
Oh, absolutely.
Just looking at the trailing 12 months, their earnings per share, or EPS, is sitting at -3 cents. And for the full year 2025, they posted a net loss of $14.01 million. I mean, they are still fundamentally bleeding money.
Yeah, they are. And while a $14 million loss is a harsh reality check, the context really matters here. Compared to the massive hemorrhaging losses of their prior years, it actually represents a significant narrowing of the gap.
So they're getting closer.
Yes, they are inching closer to the break-even line.
Well, let's look at the balance sheet and the cash flow to see how much time they actually have to cross that line. As of September 2025, they had $269 million in total cash.
Which is a solid war chest.
It is. They also reported zero debt after successfully clearing an $85 million burden. And honestly, having no debt in a high interest rate environment is incredibly rare for a growth company.
It's almost unheard of right now.
Exactly. However, their free cash flow for the full year 2025 was negative $99.12 million. They burned almost $100 million in cash to achieve that 99% revenue growth.
Which brings us to the core mechanism of hypergrowth startups.
Right.
Building an AI infrastructure isn't like opening a traditional business. You have to lay down an astronomical amount of capital upfront. You're paying for elite engineering talent, research and development, and massive server compute costs way before the revenue ever catches up.
That's like a rocket ship.
All right.
Okay, let's unpack this. They are burning fuel cash at an incredible rate to escape the gravity of their competitors.
That's a good way to look at it.
But with a $100 million annual burn rate and $269 million in the bank, do they have enough runway to actually reach orbit before they run out of fuel? Because that's roughly 2.5 years of runway before they hit a wall.
Yes, and that ticking clock perfectly bridges the gap to the stock chart.
Yeah.
Because that cash runway is finite, and the market isn't blind to that timeline.
No, the market sees everything.
Right. The market is aggressively pricing in this race against time, trying to calculate day by day if the company reaches profitability or if it just runs out of cash. And that leads to extreme volatility on the charts.
And lately, that calculation looks grim. Let's lay out the short-term reality. SoundHound closed yesterday, April 16, 2026, at $7.70.
Yeah.
That was down almost 2% for the session alone. And they were down between 22% and 30% year to date.
The erosion of value over the last 6 months has been brutal.
Absolutely brutal. Consider the historic context here. Their 52-week high was $22.17 back in October 2025. People who bought into the absolute peak of the hype have watched roughly 2/3 of their investment just vaporize.
Ouch.
Yeah. And yet the stock just bounced off a 52-week low of $5.83 in late March. The market cap is sitting around $3.28 billion right now. So is this a dead cat bounce or a genuine technical recovery?
To answer that, we really have to look at the mechanics of the technical tug-of-war happening on the charts. The signals right now are fiercely conflicted.
Conflicted how?
Well, we are seeing a burst of short-term strength, but it is entirely trapped inside a much longer-term bearish trend.
Yeah, I am looking at the 200-day moving average, which is sitting way up at nearly $12, right? While the stock is stuck down in the $7 range.
Exactly.
To me, that screams the long-term institutional money has completely abandoned ship. Is the smart money gone?
Well, when a stock is trading well below its 200-day moving average, algorithmic trading systems and institutional investors generally classify it as being in a macro downtrend.
Okay.
It is a psychological and a mathematical barrier. But on the flip side, the stock is currently trading above its 50-day moving average, which sits at $7.48.
Ah, so there's some life in it.
Yes, that indicates a recent surge in buying pressure over the last couple of months. The stock is literally being squeezed between the short-term buyers pushing up and the long-term trend pushing down.
It's completely trapped. Let's talk about the specific battle lines then. Where is the floor and where is the ceiling?
The absolute floor, like the immediate support level, is that recent 52-week low of $5.83. If the price breaks below that, there's no historical safety net.
The bottom just falls out.
Exactly. On the upside, the immediate resistance is $8.18. But the real ceiling, the major psychological barrier, is at $9.20. That is the breakout level traders are watching.
We have to look at the momentum indicators too, because they basically dictate what those algorithmic trading systems do next.
Oh, for sure.
I am looking at the MACD, and it is currently at negative 0.363, which I know is flashing a sell signal. But explain the mechanism here for us. Why does a negative 0.363 make traders hit the sell button?
So MACD stands for Moving Average Convergence Divergence. It's a tool that measures the relationship between two different moving averages, usually a fast one and a slow one. When the short-term average crosses below the long-term average, the MACD drops into negative territory. It is essentially a mathematical formula telling algorithmic traders that the downward momentum is actively accelerating.
Okay.
So a reading of negative 0.363 means the velocity of the selling pressure is currently outpacing the buying pressure. It's a short-term sell signal.
And what about the RSI?
The 14-day RSI, or Relative Strength Index, measures the speed and change of price movements on a scale from 0 to 100.
Right, and 50 is the middle ground.
Exactly. Anything around 50 is neutral. Right now, it's at 40.096.
That's leading bearish.
Down at 40, yes, it is slightly bearish. It means the stock isn't oversold enough to trigger a massive automated bargain hunting rally, but it is certainly not overbought either.
So let me get this straight. The smart money trend is broken, the moving averages look terrible, and the Man CD is telling the algorithms to sell. Yet there is a massive wave of retail volume actively buying the stock and fighting those technicals.
Right.
Why? Who are the players driving this battle? Because a stock trapped between moving averages means a war is happening.
A huge war.
Let's talk about the short interest, because this is where the plot really thickens.
Yeah.
As of late March, an astronomical 36.86% of SoundHound's float is sold short.
We need to pause and look at the sheer scale of that number. The float is the number of shares actually available for public trading.
Right.
When you short a stock, you are borrowing shares you do not own from a broker, selling them at today's price, and promising to buy them back later to return them. You only make money if the stock price goes down.
Right. It's a bet against the company.
Exactly.
Yeah.
Now, when a company has 5% short interest, the market notices. At nearly 37%, it means over a third of the entire tradable company has been borrowed and sold by institutional investors actively betting that SoundHound will fail.
Which is insane. And this is exactly what the retail traders are targeting. The sentiment on social platforms like Reddit, X, the usual retail hubs, it remains highly bullish.
Oh, yeah, they love this setup.
Right, because retail traders look at that 37% short interest, they see the $5.83 support level holding firm, and they see a mechanical vulnerability. They aren't necessarily buying because they love the 61% gross margins, right?
No, not at all.
They are buying to trigger a short squeeze.
And the mechanics of a short squeeze are violent. Because short sellers have to eventually buy the stock back to return the borrowed shares, they are incredibly sensitive to price increases.
They start sweating when the line goes up.
Big time. If the retail volume can push the stock price up high enough, the brokers who loaned out the shares will issue margin calls. They force the short sellers to buy the stock back immediately to cover their losing bets.
And that forced buying creates this crazy feedback loop.
Exactly.
The short sellers buying drives the price higher, which triggers more margin calls, which forces more buying. It is weaponized market mechanics. Retail is literally trying to trap the institutions.
But the retail traders might be getting trapped themselves. Which brings us to the internal players.
Oh man, this is the most shocking data point I found. While retail is holding the line, heavy insider selling occurred just last month in March 2026.
Yeah, that was a big red flag.
Top executives, we were talking about the chief financial officer, the chief operating officer, and the chief technology officer, they sold over $1 million worth of their own shares.
Yep.
And they sold them at prices ranging from $6.36 to $6.80. Basically scraping the 52-week low.
The contradiction here is the core mystery of the stock.
And it makes no sense when you look at Wall Street. Analysts currently have a consensus moderate buy rating on SoundHound. Their average price targets are sitting around $14.62 to $13.93. The most bullish analysts have high targets of 26 cents.
It's wild.
If the institutional experts on Wall Street are modeling this stock to double to $14, why in the world are the actual C-suite executives bailing out at $6.50?
Yeah.
That feels exactly like the pilot quietly putting on a parachute and walking to the exit door while telling the passengers over the intercom to sit back and enjoy the flight.
It is a phenomenal analogy. Honestly, that exact contradiction is why we have to debate if SoundHound is truly an undervalued innovator or just a classic retail value trap.
Fair point.
To be completely objective, corporate insiders sell stock for many reasons that have nothing to do with company performance. They have tax obligations, they might be buying real estate, or they might just be diversifying their personal wealth.
Sure.
But when the CFO, the COO, and the CTO all dump shares in the exact same window near the absolute bottom of the chart, while the company is burning $100 million a year in cash, the optics are undeniable. It mathematically signals a lack of confidence in a near-term recovery.
Which forces us to weigh the two sides of this debate. Is SoundHound an undervalued innovator that is about to squeeze the shorts to the moon? Or is it a classic retail value trap? Let's start with the bear case. Explain the risks here.
Okay, the bear case, the argument that this is a trap is rooted deeply in fundamental valuation. SoundHound is currently trading at roughly 19.5 times its price-to-sales ratio.
Meaning investors are paying nearly $20 for every $1 single of revenue the company brings in.
Precisely. And to put that in perspective, the broader software industry average is about 3.6 times price to sales.
Wow, okay. That's a huge gap.
Yeah, so SoundHound is astronomically expensive relative to its peers. Institutional money looks at a 19.5x multiple and sees zero margin of safety. Furthermore, when you combine that premium valuation with their cash burn, you run straight into the dilution risk.
Let's break down the mechanics of that dilution risk. What actually happens to the retail trader if the company runs out of cash?
So, if SoundHound burns through that $269 million before they turn a profit, they cannot just go to a bank for a massive loan with negative earnings.
Right.
Historically, their main move is using equity distribution agreements. They simply issue and sell brand new shares on the open market to raise cash.
Oh, I see. It is like slicing a pizza into 16 slices instead of 8.
Exactly. You don't have more pizza. The slice you are holding just got significantly smaller and less valuable. That threat of past equity dilution to fund operations absolutely terrifies institutional investors. Retail traders often get trapped looking at the $22 historic high, ignoring that sustained cash burn could require more dilution.
And it's not just the cash burn, right? There's the competition.
Oh, massive execution risk. They are directly competing against Google and Amazon in the voice AI space. Those are trillion-dollar behemoths with effectively unlimited capital and distribution networks. The bears argue that going up against Amazon while burning cash usually ends in disaster.
All right, I hear the bearish argument. It is grounded in historical market realities.
Yeah.
But let me play devil's advocate and pitch you the bull case, because the bears seem to be ignoring the actual technology here.
Let's hear it.
Yes, a 19.5x price-to-sales ratio was incredibly high, but the bulls argue it is entirely justified by that 99% growth rate. You don't apply legacy industry averages to a company that is doubling its footprint annually.
That's a fair point.
You are paying for the future dominance of the platform, and that future is built on their new tech, Edge Agentic plus Biggie.
And that shift from cloud AI to edge AI is really the fundamental differentiator for SoundHound.
Let's explain how this actually works. Cloud AI, which is what Google and Amazon primarily rely on, is like having to call a master chef in Paris every single time you want to chop an onion in your kitchen.
I love that.
Right. Your device records your voice, compresses the audio, sends it over a cellular network to a massive data center hundreds of miles away. The server processes the request and then sends the answer back. It takes time, and if your cell service drops, the system is completely useless.
Exact.
But Edge Agentic Plus is a multimodal AI running on device. It's like downloading that master chef's brain directly into your kitchen appliances. The AI model is physically stored and runs locally on the microchip inside the device itself.
So the processing happens without a cloud ping. This solves the two biggest hurdles in voice AI, latency and connectivity. The response time drops to practically zero, and the privacy is vastly superior because your voice data isn't being transmitted to a massive server farm.
And this isn't just some theoretical white paper, right? They have tangible momentum, solving real-world friction points.
The real deals.
Yeah, they just partnered with the Associated Carrier Group. They're expanding aggressively into the automotive sector with Stellantis. Think about the utility there.
Why?
You were driving a Peugeot or a Chrysler through a tunnel or a dead zone in the mountains. A cloud-based assistant fails. But SoundHound's on-device AI still perfectly controls the car's navigation and systems.
Which is huge for auto manufacturers.
Right. And on top of that, they're moving heavily into the quick-service restaurant space, signing deals with companies like Pete's Coffee.
The drive-through application is arguably their most lucrative immediate market.
Exactly. Why do quick-service restaurants desperately need this, though?
Well, think about it. Drive-throughs suffer from massive error rates due to ambient noise. You've got wind, traffic, engines idling. Human employees struggle to hear, leading to wrong orders, wasted food, and longer lines.
Plus the labor shortage.
SoundHound's localized AI filters that specific ambient noise better than a generalized cloud API. It takes the order perfectly every single time without needing a human taking up a headset. It fundamentally changes the economics of a drive-through.
That is massive.
The commercial application is broad, and it leads directly into the final piece of the bull argument, the management's timeline. The executives have publicly targeted near break-even profitability in the year 2026.
Wait, really? Because if they actually hit that target, the entire bear thesis basically collapses.
Yeah.
The cash burn stops, the threat of shareholder dilution vanishes, and that 99% growth rate suddenly starts generating pure profit.
Right. So when we synthesize all of this data, the financials, the technicals, the mechanics of the tech itself, You are really looking at two totally different time horizons.
Let's lay them out.
In the short term, this stock is purely a volatility play. It is a gladiator match on the charts. It's being driven entirely by the mechanics of a potential short squeeze against a very entrenched technical sell trend. Retail volume is trying to force institutional short sellers into margin calls.
But long-term, it's a completely different story. It is a binary fundamental play. It's a coin flip.
Truly. Either management executes perfectly, hits that break-even point in 2026, and solidifies their position against the tech giants by monopolizing the offline edge AI space.
Clear.
Or their hypergrowth slows down, their cash reserves dwindle, they are forced to dilute their shareholders to survive, and they just get crushed by Google and Amazon's market dominance.
Wow. So what does this all mean for you, the listener? While the market squabbles over moving averages, negative XUD signals, and short squeezes next week, I want you to think about the underlying data implication.
There's always a bigger picture.
Exactly. If SoundHound successfully deploys offline, on-device AI into millions of Stellantis vehicles and Pete's Coffee drive-thrus across the globe, who owns the prominent voice prints and behavioral data of half the country?
Oh, wow.
Yeah. Will the ultimate multi-billion-dollar value of SoundHound be its software processing? Or the massive, unparalleled offline audio data set it is quietly building, while everyone else just looks at the stock price?
That is the tangent implication that the market hasn't fully priced in yet. It's fascinating.
And I want to know where you stand on it. If SoundHound's short interest triggers a massive squeeze next week, you have to ask yourself, are you buying into a fundamental turnaround driven by real on-device AI, or are you just providing exit liquidity for insiders riding another temporary hype wave? Will the technology outrun the balance sheet? Drop your thoughts in the comments below. Take a second to hit subscribe for more deep dives, and we will catch you on the next one.